Listen, I need you to hear this before you make a decision you'll regret for the rest of your retirement. Right now, at this very moment, there's a coordinated effort happening in the precious metals market that most people won't understand until it's too late. And if you're sitting on gold right now, thinking about selling because the price has been volatile, or because your financial advisor is telling you to diversify back into stocks, or because you're nervous about what you're seeing in the headlines, I'm asking you to pause. Just pause for the next 20 minutes and let me show you what's really happening behind the scenes. Because what I'm about to reveal isn't speculation. It's not theory. It's documented fact that the mainstream financial media either doesn't understand or doesn't want you to know. And by the time I'm done, you're going to see why the smartest money in the world, the people who actually move markets, are doing the exact opposite of what retail investors are being told to do. Let me start with something that happened 3 weeks ago that barely made the news. The People's Bank of China, for the 18th consecutive month, added to their gold reserves. Now you might think, okay, China's been buying gold, that's not new. But here's what's different. They're not just buying, they're accelerating. In November alone, they added 42 tons. That's not a typo. 42 tons in a single month. And here's the part that should make your ears perk up. They're doing this while gold is near all-time highs. Think about that. The second largest economy in the world is buying an asset at record prices. Does that sound like the behavior of an institution that thinks the price is about to fall? But it's not just China. Poland just announced they're increasing their gold reserves by another 100 tons over the next 12 months. The National Bank of Poland came out and said explicitly that this is about reducing dependence on the US dollar. They didn't hide it. They didn't use diplomatic language. They said it plainly. We're buying gold because we don't trust the dollar system anymore. And Poland isn't some small player. They're a NATO member, a European Union country, deeply integrated into Western financial systems. When they start publicly moving away from dollar dependence, that's a signal. Turkey, India, Singapore, the Czech Republic, all of them have been net buyers. And we're not talking about small purchases. We're talking about systematic, sustained accumulation that's been happening for years now. Central banks globally added over 1,000 tons of gold in 2023. They're on pace to exceed that in 2024. These are the institutions that have access to information you and I will never see. They have economists, analysts, intelligence briefings. They know what's coming in the global monetary system, and they're preparing. Now, while all of this is happening, what are you hearing from mainstream financial advisors? Sell your gold. It's a barbarous relic. It doesn't pay dividends. You should be in the S&P 500. You should be in bonds. You should be diversified across traditional assets. And I'm not saying those advisors are lying to you. Most of them genuinely believe what they're saying. But they're operating on a framework that was built for a world that no longer exists. They're using models and assumptions from an era when the US dollar was unquestionably the global reserve currency, when inflation was under control, when debt levels were manageable, when geopolitical stability was the norm. That world is gone. Let me give you some context. In 1971, Richard Nixon closed the gold window. That was the moment when the US dollar officially became a fiat currency, backed by nothing but the full faith and credit of the US government. And for 50 years, that system worked. It worked because the United States was the dominant economic and military power. It worked because oil was priced in dollars. It worked because there was no alternative. But we're watching that system crack in real time. The BRICS nations, Brazil, Russia, India, China, South Africa, they're not just talking about creating an alternative to the dollar anymore. They're building it. They've invited over 40 countries to join their alliance. They're settling trade in their own currencies. They're creating payment systems that bypass SWIFT. And at the center of all of this is gold. Not as a currency, but as a settlement mechanism. As a neutral asset that no single country controls. This isn't conspiracy theory. This is documented policy from these governments. Russia, after being cut off from the Western financial system, immediately pivoted to gold-backed trade settlements. They're selling oil and gas to India and China and accepting payment in rubles, yuan, and gold. Saudi Arabia, the cornerstone of the petrodollar system for half a century, is now accepting yuan for oil sales. They've opened yuan clearinghouses. They're in discussions to join BRICS. When Saudi Arabia moves away from exclusive dollar pricing for oil, that's not a small shift. That's a tectonic plate moving under the global financial system. And here's what most people don't understand about gold in this context. Gold isn't going up because of inflation alone. It's not going up just because of geopolitical tension. It's going up because the entire architecture of global finance is being rebuilt, and gold is the foundation of the new system. Central banks are accumulating gold because they know that in a multipolar world where no single currency dominates, gold is the only asset that every nation trusts. It's the only asset that can't be printed, can't be sanctioned, can't be frozen in a foreign bank account. Now, let's talk about what's happening in the physical market, because this is where things get really interesting. There's a massive disconnect right now between the paper gold market and the physical gold market. On the COMEX, the futures exchange where gold is traded, you can buy and sell contracts representing gold without ever touching an actual bar. It's a paper market, and the price you see quoted every day, that's largely determined by this paper market. But here's the problem. The amount of paper gold being traded dwarfs the amount of physical gold that actually exists to back those contracts. The COMEX has a fractional reserve system for gold. For every ounce of physical gold in their vaults, there are multiple claims on that same ounce through futures contracts. As long as everyone doesn't ask for delivery at the same time, the system works. But what happens when the music stops? What happens when a significant number of contract holders say, "I don't want to roll my contract forward, I want my gold delivered"? We got a preview of this in March 2020. During the COVID panic, the spread between paper gold and physical gold blew out to over $100 an ounce. People who wanted physical gold couldn't get it. Dealers were sold out. Premiums went through the roof. Meanwhile, the paper price was being hammered down by futures selling. That disconnect revealed the fragility of the system, and it's happening again, just more slowly and less obviously. Right now, if you go try to buy physical gold, 1-ounce bars, coins, you're paying significant premiums over spot price. Why? Because there's a shortage of physical metal. Refineries are running at capacity. Mints can't keep up with demand. And yet the paper price isn't reflecting this physical tightness. That's not normal. In a functioning market, when physical demand exceeds supply, the price goes up until equilibrium is restored. But in the gold market, the price is being set by paper trading that has no connection to physical reality. And here's where it gets even more interesting. The London Bullion Market Association, the LBMA, which is the center of the global physical gold market, has been experiencing unprecedented withdrawals. Tons of gold are leaving their vaults and being shipped to Asia, to China, to India, to Singapore. This isn't speculation. The LBMA publishes vault data. You can see it yourself. Physical gold is flowing from west to east at a rate we haven't seen in decades, and it's not coming back. Why does this matter? Because when gold leaves Western vaults and goes to Asia, it's moving from weak hands to strong hands. It's moving from financial institutions that view gold as just another trading asset to central banks and private buyers who view gold as permanent wealth. Once that gold is in a Chinese central bank vault or in the hands of Indian households, it's not coming back to the market. It's being removed from the available supply permanently. Now, let me address something that I know is on your mind. If you're a retiree holding gold, you're thinking, okay, all of this sounds concerning, but I need income. I need liquidity. Gold doesn't pay me anything. I'm sitting on an asset that's just sitting there. And I get it. That's a legitimate concern. But let me reframe this for you. Gold isn't an income asset. It's an insurance asset. It's a wealth preservation asset. And in the environment we're entering, preservation is going to matter more than yield. Because what good is a 5% yield if the currency that yield is paid in loses 20% of its purchasing power? You're not making money. You're losing money in real terms. Gold doesn't pay you a dividend, but it also doesn't have counterparty risk. It can't default. It can't be inflated away. It can't be hacked. It can't be frozen by a government. In a world of increasing financial instability, those characteristics are worth more than yield. And speaking of retirement accounts, if you're sitting on $100,000 or more in a traditional IRA or 401k, there's something you should know. You can hold physical gold inside a retirement account. It's called a gold IRA. I'm not going to spend a lot of time on this, but I put together a free guide that explains how it works, how you can move funds from an existing retirement account into physical gold without triggering taxes or penalties, and what the rules are. It's in the description below. If that's relevant to your situation, it's worth looking at. Because one of the biggest mistakes I see retirees make is thinking they have to choose between retirement account tax advantages and owning physical gold. You don't. You can have both. All right, back to the bigger picture. Let's talk about what's happening with the US dollar, because this is the elephant in the room that nobody wants to acknowledge. The United States has $35 trillion in national debt. That number is so large it's almost meaningless. But let me put it in perspective. The entire U.S. economy, everything produced in a year, is about $28 trillion. We owe more than our entire annual economic output, and we're adding $1 trillion to that debt every 100 days. Now, how do you service that debt? You have two options. You either raise taxes, which is politically impossible, or you print money. And when I say print money, I don't mean literally running printing presses. I mean the Federal Reserve creates new dollars electronically and uses them to buy government bonds. That's quantitative easing. That's monetary expansion. That's inflation by another name. The Federal Reserve has been trying to fight inflation by raising interest rates. And on the surface, it looks like it's working. Inflation has come down from 9% to around 3%. But here's what they're not telling you. The only reason inflation came down is because they crashed demand. They made borrowing so expensive that businesses stopped expanding, consumers stopped spending, and the economy slowed down. But they can't keep rates high forever. Because with $35 trillion in debt, every percentage point increase in interest rates costs the government hundreds of billions of dollars in additional interest payments. We're already at the point where interest on the national debt is one of the largest line items in the federal budget. It's bigger than defense spending, it's bigger than Medicare, and it's growing. At some point, and that point is coming soon, the Federal Reserve is going to have to make a choice. Do they keep rates high and risk a debt crisis? Or do they cut rates and let inflation run hot again? And I'll tell you right now what they're going to choose. They're going to cut rates. They're going to print money. They're going to inflate the debt away, because that's the only politically viable option. And when that happens, when the Fed pivots back to easy money, gold is going to explode. Not because of speculation, not because of fear, but because the market will finally accept what's been obvious for years. The dollar is being systematically devalued, and there's no way to stop it without collapsing the entire system. Let me give you a historical parallel. In the 1970s, the United States faced a similar situation. We had just come off the gold standard. We had massive government spending from the Vietnam War and the Great Society programs. We had an energy crisis. Inflation was running hot. And gold went from $35 an ounce in 1971 to over $800 an ounce in 1980. That's a 22 times increase in less than a decade. And that was in an era when the U.S. was still the dominant global superpower, when the dollar was still unquestioned as the reserve currency, when there was no alternative financial system being built by rival powers. Today, we have all of those same inflationary pressures, plus we have a geopolitical challenge to dollar dominance that didn't exist in the 70s. We have central banks actively diversifying away from dollars. We have countries settling trade in alternative currencies. We have a debt burden that's multiples of what it was back then. And we have a Federal Reserve that's already shown it will print unlimited amounts of money when the system is threatened. If gold went up 22 times in the 70s under those conditions, what do you think it's going to do in the environment we're entering now? Now, I know what some of you are thinking. You're thinking, but gold has already gone up. It's at all-time highs. Isn't it too late? And I understand that psychology. It feels counterintuitive to hold an asset that's already appreciated significantly. But let me ask you this. If central banks thought gold was overvalued, would they be buying at these levels? If the smartest institutional money in the world thought gold had topped out, would they be accumulating? The answer is no. They're buying because they know this is just the beginning. They know that when you measure gold, not in dollars, but in terms of purchasing power, in terms of what it can buy, it's actually undervalued relative to the money supply. The Federal Reserve's balance sheet has gone from under $1 trillion before 2008 to over $8 trillion today. The money supply has exploded, but gold has only gone from around $800 an ounce to around $2,000. It hasn't kept pace with monetary expansion, which means in real terms, adjusted for the amount of currency in circulation, gold is cheaper today than it was 15 years ago. And here's another thing to consider. Gold is still only a tiny fraction of global financial assets. If you add up all the gold ever mined in human history at current prices, it's worth maybe $15 trillion. That sounds like a lot until you compare it to global stock markets, which are worth over $100 trillion, or global real estate, which is worth over $300 trillion, or global debt, which is over $300 trillion. Gold is a rounding error in the global financial system. If even a small percentage of that capital shifts into gold as a safe haven, as insurance against monetary instability, the price will go exponentially higher. Let me tell you about something that happened in 2008 that most people have forgotten. When Lehman Brothers collapsed and the financial system was on the brink, there was a moment, a brief window, where physical gold became almost impossible to buy. Dealers were sold out, premiums spiked to 30, 40, 50% over spot price. People who had been thinking about buying gold suddenly couldn't get it at any reasonable price. And the people who already owned it, the people who had bought it years earlier when everyone said they were crazy, they were the ones who were protected. We're heading into a similar moment. Not tomorrow, not next week, but it's coming. And when it arrives, it's going to happen fast, faster than most people can react. The time to position yourself isn't when the crisis is obvious to everyone. It's when the signs are there, but most people are still in denial. And right now, we're in that denial phase. The mainstream narrative is still that everything is fine, the Fed has inflation under control, the economy is resilient, the dollar is strong. But the actions of central banks, the flow of physical gold, the geopolitical realignment, all of it is telling a different story. Here's what I want you to understand. Selling your gold right now, at this moment in history, is like selling your homeowner's insurance the day before a hurricane. You might save a little money in the short term, but you're exposing yourself to catastrophic risk. And unlike homeowner's insurance, which you pay for every year and hope you never need, gold is an asset that holds value. It's not a cost. It's a store of wealth that's been recognized for 5,000 years across every civilization. Think about what gold represents. It's the only form of money that's survived every empire, every currency collapse, every financial crisis in human history. The Roman denarius is gone. The Spanish real is gone. The British pound used to be the global reserve currency, and now it's a shadow of what it was. Every fiat currency that's ever existed has eventually gone to zero. But gold is still here. It's still valuable. It's still recognized everywhere in the world as real wealth. And in times of crisis, that matters. In Weimar Germany in the 1920s, people who held gold survived the hyperinflation. People who held paper marks lost everything. In Zimbabwe in the 2000s, people who had gold could buy food and necessities. People who relied on Zimbabwean dollars starved. In Venezuela right now, gold is functioning as a parallel currency because the bolivar is worthless. These aren't ancient history. These are modern examples of what happens when monetary systems fail. Now, I'm not saying the US dollar is going to hyperinflate tomorrow. I'm not saying we're going to turn into Venezuela. But I am saying that the trajectory we're on is unsustainable. And the people who are in positions of power, the people who have access to the best information, they know this. That's why they're buying gold. That's why central banks are repatriating their gold from foreign vaults. That's why countries are building alternative payment systems. They're preparing for a world where the dollar is no longer the unquestioned king of global finance. And here's the thing about that transition. It doesn't have to be dramatic. It doesn't have to be a sudden collapse. It can be a slow, grinding loss of purchasing power, a steady erosion of confidence, a gradual shift in global trade patterns, and by the time the average person realizes what's happened, it's too late to protect themselves. The gold is already gone. The premiums are already sky high. The opportunity to preserve wealth has passed. That's why I'm telling you, if you own gold right now, hold the line. Don't let short-term volatility shake you out. Don't let financial advisors who don't understand the macro picture convince you to sell. Don't let fear of missing out on stock market gains cause you to abandon the one asset that's actually protecting you from systemic risk. Because here's what's going to happen. The stock market might go higher in the short term. Bonds might rally if the Fed cuts rates. Real estate might hold up in certain markets. But all of those assets are denominated in dollars. They're all dependent on the continued stability of the financial system. They're all vulnerable to inflation, to currency devaluation, to policy mistakes. Gold is the only asset that exists outside that system. It's the only asset that benefits when confidence in the system erodes. And we're watching confidence erode in real time. Every time the debt ceiling gets raised. Every time the Fed has to step in and bail out banks. Every time inflation comes in hotter than expected. Every time a foreign country announces they're reducing dollar reserves. Every single one of those events is a crack in the foundation, and gold is the asset that appreciates when people start to notice those cracks. Let me give you one more piece of evidence that should make you think twice about selling: the gold to silver ratio. Historically, gold and silver move together. They're both precious metals, both used as money throughout history. Both respond to similar market forces. The long-term average ratio is about 60 to 1, meaning 1 ounce of gold equals 60 ounces of silver. Right now, that ratio is over 80 to 1. Silver is historically cheap relative to gold. Why does that matter? Because when the precious metals market really takes off, when we get that explosive move higher, silver tends to outperform gold. It's more volatile, more industrial, more speculative. But the fact that silver hasn't moved yet, the fact that it's still lagging, tells you that the big move in precious metals hasn't happened yet. We're still in the accumulation phase. The smart money is still building positions. When silver starts to catch up to gold, when that ratio starts to compress, that's when you'll know the real bull market has begun. And if you've sold your gold before that happens, you'll be watching from the sidelines. So, here's my message to you. If you're a retiree, if you've worked your whole life to build wealth, if you've been smart enough to own gold as part of your portfolio, don't give up that position now. Don't let anyone convince you that gold is a relic, that it's outdated, that you should be in something else. The world is changing. The financial system is being restructured. And gold is going to be at the center of whatever comes next. Hold the line. Stay patient. Trust the process. And remember that the people who are telling you to sell, they're not the ones buying. The people who are buying, the central banks, the sovereign wealth funds, the billionaires who understand how this game is played, they're not selling. They're accumulating. And when this is all over, when the dust settles and the new monetary system is in place, the people who held gold are going to be the ones who preserved their wealth. The people who sold are going to be the ones asking what happened. Don't be that person. Hold the line.